In the 2025 autumn budget, pensioners are facing a set of unprecedented financial changes that will dramatically reshape retirement planning, savings, and inheritance strategies, and today, we're going to break it down in detail, digging into what these measures mean for your pocket, your pension, and your future, without any political spin, just straight financial insight. Starting with the big picture, the Office for Budget Responsibility has forecasted a £40 billion annual tax increase, the most significant since 1993, and while a portion of this comes from frozen personal allowances and thresholds that marginally protect those living solely on the state pension, anyone with private savings, investments, or second homes is entering what could easily be described as the most aggressive overhaul of private retirement wealth in recent memory. There are 6 specific measures that will hit pensioners hardest, beginning with the inclusion of most defined contribution and defined benefit pensions within inheritance tax from April 2027. Previously, pension pots left to children or other non-spouse beneficiaries largely escaped this levy, but now, amounts above approximately £1 million will be taxed at 40%, creating potential 6-figure bills that were unheard of before this reform, marking a structural shift comparable in magnitude to the 2015 pension freedoms. And the Treasury expects to generate around £23 billion annually from this measure by the early 2030s. The second major hit comes from dividend taxation, which will rise by 2 percentage points in April 2026, pushing the basic rate from 8.75% to 10.75% and the higher rate from 33.75% to 35.75%, meaning that a standard £200,000 equity portfolio yielding 4% could see around £1,600 a year stripped from returns, directly affecting the monthly budget of retirees. Similarly, interest on savings outside the personal savings allowance will be taxed at higher rates beginning April 2027, with basic rate taxpayers moving from 20% to 22% and higher rate taxpayers from 40% to 42%, translating into losses of £400-800 annually on a £100,000 cash pot, while cash rates remain relatively modest. Beyond these direct hits, frozen thresholds are pushing more pensioners into the higher 40% tax band, with forecasts suggesting that around 800,000 additional retirees could be affected by 2030, meaning that as state pensions rise in line with the triple lock projected at 4.8% next April, more of the pension will become taxable, eroding net income even as the headline numbers suggest improvement. Capital gains tax on residential property continues at 18%, 24%, but perhaps the most punitive reform affects farmers and family business owners, as agricultural and business property relief is capped at a combined transferable allowance of £1 million, reducing full relief to 50% above that limit, and creating potential 7-figure tax bills for farms or businesses valued in the multi-million-pound range, forcing families to seriously reconsider succession plans and asset distribution strategies well before the legislative deadlines. While these changes are undeniably challenging, the budget does contain modest offsets. State pensions remain protected by the triple lock, translating to £475, £575 extra per year depending on the current pension amount. Energy levies are being removed from electricity bills from April 2026, saving an average household roughly £150, and the 5p fuel duty cut continues for another year, providing about £89 in direct savings for motorists. Other smaller gains include the freezing of prescription charges in England, rail fare freezes, and the permanent continuation of the Help to Save scheme, which provides a 50% government bonus for qualifying savers, meaning that for those living solely on the state pension with no significant investments, the net result could be an extra £600, £800 per year, but for anyone holding private wealth, these gains are substantially outweighed by the losses. This leads to a crucial consideration: proactive planning is essential, and there are concrete steps that can protect your wealth ahead of these changes. Before April 5, 2026, fully funding both your own and your spouse's ISAs up to £20,000 each annually can shelter up to £80,000 in a couple's portfolio from the dividend and savings interest tax increases. Reviewing and updating pension expression of wish forms is critical, ensuring that your intended beneficiaries maintain control over who receives your money before inheritance tax applies. For those with large unspent pensions looking to pass wealth efficiently to children or grandchildren, considering accelerated drawdowns into ISAs or spousal bypass trusts before April 2027 could substantially reduce future tax liabilities, always in consultation with a regulated financial advisor. Annual gifting also remains a valuable tool, with £3,000 per year per person and normal expenditure out of income exemption still intact, allowing tax-efficient wealth transfer while the rules remain favourable. High dividend shares outside of ISAs should be transferred inside before April 2026, utilising the BED and ISA strategy while still permitted, and family businesses or farms must begin succession planning immediately to mitigate the impact of the £1 million relief cap. The reality set by the 2025 budget is that private pensions are no longer an effective tax-efficient vehicle for intergenerational wealth transfer, and investment income is being taxed at levels approaching those for earned income, a fundamental shift that has been legally codified and cannot be ignored. Adapting to these new rules is now a necessity rather than an option, and acting quickly on strategic steps can save significant sums, while failing to act may result in devastating losses that could have been avoided with proper foresight. This is a moment for vigilance, for taking full ownership of your finances, and for ensuring that you are using every available allowance, relief, and planning tool to protect your retirement and inheritance goals. By understanding the specifics of these 6 major measures: inheritance tax on pensions, dividend tax increases, interest tax rises, frozen thresholds pushing more pensioners into higher tax brackets, capital gains tax stability, and the capped relief for agricultural and business property retirees, can formulate a targeted action plan, while also appreciating the limited but meaningful benefits still offered by state pensions, energy and fuel savings, prescription charge freezes, rail fare freeze, and the Help to Save bonus. The overarching lesson is that the financial landscape for UK pensioners has been redrawn in a way that significantly penalises private wealth while modestly supporting state pensioners, and therefore careful planning, timely investment decisions, and expert guidance are now more important than ever to navigate these changes successfully. Protecting your assets, ensuring proper beneficiary designations, maximizing tax-advantaged accounts, and implementing thoughtful gifting and succession strategies are no longer optional enhancements, they are essential survival tactics in this new retirement environment. Whether you are a retiree with substantial private assets, a farmer managing generational business transfers, or someone planning for a secure future, this budget signals a clear call to action: understand the rules, act decisively, and take control of your finances before the statutory deadlines force less favorable outcomes. The legislation is now in place, and while you cannot undo the policy decisions, you can optimize your response, reduce exposure to punitive tax measures, and safeguard both your day-to-day retirement income and the legacy you hope to leave behind. In summary, these 6 major tax and threshold changes: the inclusion of pensions in inheritance tax, dividend and interest tax increases, frozen thresholds pushing more pensioners into the 40% band, the cap on agricultural and business relief, and the unchanged but important small reliefs together represent a seismic shift in UK retirement policy, and understanding each detail is critical. By taking the proactive steps outlined, including maximizing ISAs, reviewing expression of wish forms, accelerating drawdowns when appropriate, strategic gifting, moving high dividend shares into tax-advantaged accounts, and planning succession for family businesses or farms, pensioners can mitigate losses and potentially preserve hundreds of thousands of pounds that would otherwise be lost to the Treasury. These changes are not abstract, they affect your day-to-day spending, your long-term savings, and your ability to leave a tax-efficient legacy. The time to act is now, and being informed, prepared, and decisive is the best defense against the significant financial shifts introduced in the 2025 budget. Look after your money, because no one in Westminster is going to do it for you. Every step you take now can make a real difference to your retirement quality of life, the security of your investments, and the inheritance you leave behind, and with careful planning and professional guidance, it is still possible to navigate these challenges successfully. So take action, stay informed, and subscribe to my channel for ongoing advice and insights to protect your wealth, maximize your retirement security, and make sure that the changes in this budget don't catch you off guard, because staying one step ahead is the key to financial survival and peace of mind in this rapidly changing environment.